Welcome back, everyone. I hope you enjoyed that. Our final speaker for today, and I'm very pleased to welcome Walter Aylett, founder of Aylett and Company. Walter's the portfolio manager on the Nedgroup Investments Bravata Worldwide Flexible Fund. Walter, I know you on your stretch session, so weren't able to join us in person, but we are so thrilled that you were able to share some of your time with us today. So thank you. How are you doing?
My pleasure. No, well, thank you.
Great, great. I'm sure you and the team are getting some good insights. I mean, if you look at fund performance, I mean, Bravata is celebrating its 20-year anniversary this month. Can you believe it? Unbelievable. Wow. It's such an amazing time. And if you look at the performance, you guys are definitely celebrating in style. Hey?
Yeah, it's been better, but we've taken some investment bets that are a little bit contrarian at the moment. Like we're very positive on South Africa valuations. So yeah, that's good. We're not satisfied, but we're patient.
Okay, great. So Walter, let's kick off then. So can you please take us through some of the performance numbers in more detail?
Yeah, happily we'll do that. Obviously, I've always believed that one invests to preserve one's purchasing power, and we've kind of used CPR plus 5 as a kind of a benchmark, if you want to call it that. And if we can do that over the long term, we'll be more than satisfied with those returns. And I think we're using compounding around 11.7% per annum since inception. That's over 20 years. Over the last 5 years, we've more than doubled your money. In other words, our return has been 15% per annum. And remember, our returns are after costs. So in that respect, yeah, I think we're achieving by our high standards what we want to achieve, but we would like to do more than that. I think when one looks at performance in the fund, our best investments are made when it appears when we're not doing that well. And the reason why is that you're taking investments that are not popular. And when the markets from time to time, drop 10, 15%, they tend to take everything down and they give you another shot at the shares that you like at much lower prices. And then of course, as we get better information about the investments, we tend to also increase our investments in terms of the size of the investment that we make. So we're in one of those periods right now in terms of investment performance.
Thanks, Walter. I mean, perhaps if you can zoom in to the past year specifically, and if we can talk through the attribution analysis, please. I know We Buy Cars is just completely surprising on the upside, but yeah, which are some of the other ones that you'd like to highlight?
Yeah, I think BAT did very well for us. That comes to mind. I think really the performance this year, one mustn't get too ahead of oneself. I think we stayed out of trouble more than make big investments. Something like BAT, when we started buying was around £30. It was only recently that it went to 38, £40. But that was over 4 or 5 years. But the dividend was 10% on what we paid. So that gets hidden in the actual share price that you don't see. So there's a lot of that's happening. And I think I was particularly pleased with some of our investments in oil-related stocks, SBMO, which makes these big oil ships that float above the water and pump the oil from 5-6 kilometers down underneath the sea. And then another company called Ruby, which is more of a fuel services company, like you'll know there's Easy Gas in this country. So we've exited most of those. We're starting to, those two shares have done reasonably well for us. Also, again, very high dividend yielding shares. So there's a bit of a theme in that we're a bit of it's a bit of a tortoise approach at the moment in the fund. We don't have the technology stocks. And of course, Berkshire had made us so much money over 20 years. We've now down to 1% from 10% of the fund. On the negative side, it's a lot of little stocks. When you add them up, they make up about a minus 5%. So they're 0.7, 0.4, 0.6. I think one was an error of commission, as I call it, which was Sabre. very disappointing. And I think we uncharacteristically invested in a company that has debt on its balance sheet. And then, of course, Newton, that came out of transaction capital, is just disappointed. It's just taken a lot longer to fix itself in its traditional business. And the rest is fine. We haven't made many mistakes.
So, Walter, thanks so much. Why would you say the market is still discounting South African equities so heavily despite improving fundamentals? Would you say this is a value trap or a real opportunity that we have here?
I don't think it's a value trap at all. Look, if you look at the headline all share, you're up about 40% in dollars. So the South African market hasn't disappointed. Unfortunately, when you look at the makeup of that performance, it's gold and Naspers process, which effectively are Chinese investments. And then I do think the platinum companies are starting to come to the party as well in terms of following the high gold price. Therefore, the platinum price has run. And so you've seen some very good performance there. I don't think we do a good job of promoting South Africa offshore. And but the rand has strengthened and the bond market has strengthened. So it's a bit unfair to say that we've been neglected. It's the equity markets, the industrial counters that have been neglected. And I think we've done something, we'll see a little bit later, we've done something quite uncharacteristically. Not only have we increased our exposure to South Africa, but we've taken quite a big investment as a first step in South African banks. We own all 4 banks now, which make up about 6% of the fund. And that was just a view on the banking sector. It's got too cheap. And when you look at the long bond of South Africa, which has come down quite a lot, it's the yield. The banks have not caught up with it yet. And we suspect that you'll see something like that. So I think, there's things that have been ignored in South Africa, which are quite positive. In other words, we don't have an Eskom crisis anymore at the moment. Interest rates have come down. There's the bond market. Interest rates for government have come down. So their borrowing costs have come down. The rand is definitely strengthened. So our imported products have become a little bit cheaper if you think of petrol, oil prices. I do think we've seen, the government won't admit it, but there's a partial nationalization of infrastructure assets. In other words, Transnet and South Africa, the ports and the railways. And if you add that all up together, that's quite good. We're just not seeing it in the economy yet. And I think if we just get a bit of a surprise on the economy, we might just look back and say we've bottomed. I mean, just look at the platinum price at these levels. If it stays where it is, must be very good for South Africa. Hopefully there's demand at that price. And certainly there's a bit of gold we still produce. And then also our agricultural sector is not going to disappoint. So if we're a primary economy, we're not a consumer-driven economy, I think. Get those 2 sectors and you can get it to the port and export, we'll be fine. Tariffs is going to hurt. There are motor companies that are shutting down in the Eastern Cape, like Goodyear. So there's a bit of a negative, positive, but I think overall we're pretty shot. And it seems to me that there's a little bit of more optimism around. And once you get optimism around, the economy will follow, and the stock market will predict that. And the other thing is, I think our Reserve Bank are doing a very good job in managing interest rates. They're going to go for 3%, and 3% inflation is very good for South Africa if the government allows them to do that instead of the 3 to 6% benchmarking that we see.
Walter, thanks very much. So you've also been building your position in alcohol stocks recently, and we've actually seen a variety of new names entering the portfolio. What would you say is driving growth in those sectors, please?
I don't think anything's driving growth at the moment. It's a bit like the tobacco stocks 5-6 years ago, where no one wanted to own tobacco stocks. And I think that in a similar vein, we're going to see that happen in the alcohol stocks. Remember, it's a hangover from COVID. Too much stock in the system. Prices were too high. We've had the tariff destruction of certain supply chain in the United States. United States is the biggest market for the alcohol-related companies. I think you've got to go break it down step by step. So if we look, first of all, Budweiser and Heineken are beer companies. They've been having their challenges for the last 4 or 5 years before kind of COVID. And we think they're in a very good place as you move towards premiumization of beer. In other words, the emerging markets, as they become wealthier, they will move up the value chain of beer, if you think of it that way. We don't need them to drink more beer. We just need them to drink a bit more expensive beer. And then on the spirit side, things like Remy Martin, which is a cognac company, as well as Beckel, which is a tequila company. We think you'll be drinking tequila and cognac in 10 years' time. And those are really the only two places you can get the spirits. Of course, you need China and America to come to the party. And then finally, we have Diageo, which is a multinational liquor company. Primarily, it's Guinness and Johnny Walker that drive a lot of that valuation. But I think one thing that's been not appreciated by the market is, before you couldn't really advertise alcohol, say around the soccer stadium. You now can do Guinness Zero and Heineken Zero, which effectively you're advertising the two brands, if you think about it that way. And I think those management teams are getting a shake-up. Some are being replaced. So I do think that we're getting brands at very good prices. And then finally, an additional investment in Budweiser Asia, which is really China, Vietnam, and India. If you think the next 5 to 10 years, 20 years, I think we'll be drinking more of those brands, which will then benefit Budweiser Asia Pac, Asia Pacific. So overall, it's quite a strong liquor play that we've got. So it's not earnings that are driving it. It's more cost cutting and normalizing the supply chain and stock levels in the system. And believing that ultimately young people will move towards alcohol again as they get richer.
Yeah, sure. Just, I guess, before we start focusing more on the portfolio itself, if you can just please summarize your view on markets and outlook.
I must say it's my 30 years of investing, I think, yeah. I don't think I've had it as hard as it is today, in the sense that the good old-fashioned maxim or rules of earnings drives share prices seems to have just been pushed aside. Certainly, if you don't buy the technology stocks or the top 10 in the S&P 500, you're left behind. And I mean, I was just reading an article how short sellers are becoming extinct because the retail investor just kills it. And I think there is a breed out there, a tech breed, a young person's breed that is totally out of kilter. It's a bit of a casino effect in the markets, I think. And it's very, very hard to understand what's happening. If one looks further out, that's 5, 10 years out, I think we're in for very difficult times. I think America, which makes up about 70% of global stock markets, is way too high. I think what they're doing is like Brexit. They're just slowly destroying they've moved from a global superpower to a regional superpower, in my opinion, showing very poor leadership, thinking that they can do it on their own. So they're breaking all the rules of why globalization really worked, why tariffs didn't make sense, the benefit or the advantage of comparative production. In other words, if you can make a pencil cheaper in China, you should make it there and import it. We had relative peace over the last 30 years, 40 years that I mean, my generation has had the best of best, a declining interest rate environment. You could travel all over the world. The Iron Curtain came down, the Bamboo Curtain came down. It was just a wonderful place for stock market. So the question is, going forward, will the Europeans and the Asians come to the party and become independent and deliver? And I think ultimately they will. Europe's got big challenges, negative growth rates in terms of population growth. very expensive electricity, energy, and they really have to come up with some kind of creativity and innovation. It's not good enough now to borrow money to build defensive armaments. And then Asia, I think, is probably going to be the place where we're going to do really well, simply because they get on with it in all these classes. Yeah, so it's going to be very interesting. And then I do believe we're going to have nuclear proliferation, because the superpower used to take care of Australia and Japan and South Korea, and that's gone. And so I can't see a positive outlook. And I think there's a huge washing out phase that has to come to wash out the excess capital in the States. Capital is cheap, it's a commodity. I heard someone say today, capital is a commodity. Nonsense, capital should be precious. And there's a cost to capital. So there's just simply too much money chasing too few assets, and the rich get richer, and that ultimately has to burn a hole in their pocket. So I much prefer our approach of buying the predictable, uncertain, predictable, certain investments. I think you will be smoking in 10 years. I think you will be drinking beer in 10 years' time. I think South Africa's valuation takes care of a lot of problems. We have very good companies that are lean, with a lot of cash on their balance sheets. And we're a young country, if you think of it. We get too obsessed with our 10-year history or 5-year history. We've only been going for 30 years, so as a proper country. So I think we've got room to fix things. And I travel all over the world, and I'm much more optimistic on us sorting South Africa out. We've got problems, no doubt about it, but the world has got just as bigger problems.
I think with all the problems in the world, it's probably a good idea to be well diversified. And Bravata, for as long as I've known it, has always been a very well diversified portfolio. So, Walter, can you please take us through the asset allocation now?
Yeah, we're about probably the most we've been exposed in equity now. We're 90%, which is quite bullish if you think about it. But when you look through it, it's 7-8% Renet, which is essentially becoming a cash shell. And then if you look at where the money's gone, it's 50% South Africa. We were big investments in bonds for quite a while. Most of that's gone now, South African bonds. And then at the small level, we started buying new companies like Storage, Oceana Fishing, added more to the companies that we really know well. We've had opportunity to buy more of those shares. We've spoken about some of them, the liquor companies. And yeah, we just keep on buying what we know as they get neglected by the market. And then you'll see Billiton is now 1% of the fund. The banks are 6.5% of the fund to 7%. And South African banks, which is very unusual for us. So it's a small bet on South Africa. I would love to be 100% South Africa. Personally, I think we've got huge opportunity. I just wish I'd bought the all shares instead of the shares. It would have been up 40% in dollars. But that's just the way it is. So I think that's where all the money's gone. And yeah, Netcare is a hospital group in South Africa. We've added quite a lot of money to that investment. Remgro, a holding company with South African assets, trading at a discount of 40% to those assets. If you think of Mediclinic, Outsurance, we need those companies as consumers. We're getting them at a 40% discount. And then we bought Spar, which is a retailer, food retailer, which is busy fixing itself up. Yeah, I think, and then we got a few diehards in the fund like ACI, which just have had a lot of bad luck. But disappointing from our side. We just go sideways on ACI, but who knows? Some of the smart value investors also own it now. Maybe they hope they're right, and we go along for the ride. That's Bravata. Bravata is predictable. It's very predictable. It's going to be a lot. It's got some big dividends, that come out of these companies. So I was just thinking, the banks are giving you between 5 and 10%. The oil companies are going to give you 6% that we own Total, and Shell's 3.5%, 4%, and BAT, that's another 6, 7%. We've got Philip Morris. We've got that we started buying. We had British Imperial Tobacco, and then the global fund itself has got quite a high dividend yield. That we've got a small investment in that fund. So overall, that's the fund. It's not hard to. Yeah, it doesn't change much, as you know. We've been much more active than I think we have in the past, and it's those ideas that I just told you about.
So Walter, thanks very much. That was very insightful in terms of the composition of the portfolio, some of the top 10 holdings, entries and exits, and so on. I guess just any final words before we close off today?
Yeah, look, I think predicting like Chicken Licken that the sky is going to fall on our heads, I think is a waste of time. But I think I would caution investors to be very have low expectations. We are going to have very volatile markets, I believe. Our portfolio is fully invested, so we are going to be quite volatile if the markets go up and down, not because of the shares that we own. So one should temper one's expectations. But if I'm 10% right on South Africa, the South African part of the portfolio will give it very good diversification, very good risk reduction benefits. So, but remember, we're a 5 to 10 year time horizon fund, and if you don't have that type of horizon, then Bravata is not for you. Most of our investors do have that, as you know. This fund has benefited from long-term investors. So, this I think started 300 million, 350 million when we started on day one 20 years ago. It's now 2.7 billion, 2.6 billion, somewhere around there. So they know that, but I would caution, just be conservative, and if we're wrong, we've got upside.
Walter, thank you so much. It's always a pleasure hearing from you, and we really appreciate having you join us today.
Thank you.
Great, thanks.